Hey guys, and welcome back to another video. In today's video, we're going to be doing part 2 of this little series talking about how to interpret and really understand these Treasury auction results, as well as how exactly the Treasury auctions work. Now, I already did that video on how the auctions work, and I will link that in the comment section down below. So if you haven't watched it, I highly suggest it, but let's get right into today's video. Now, today's video, like I said, is going to be a little more focused on understanding some of the trends or some of the important data that we can pull out of these Treasury auctions to understand maybe how the market is reacting and potentially also help us predict future interest rates. The first thing that we're going to be talking about is the bid to cover ratio, and the basic idea of this is how much money is being bid in total versus the amount of money that is actually being accepted, which is based on the amount of treasuries being offered by the Treasury Department. Now, that was a little wordy, so let's look at these actual Treasury auction results and I'll show you what exactly I mean. Now, we're going to go ahead and look at both the January and the March Treasury auction results for a 1-year T-bill, and this is going to illustrate some of the trends for us. So starting off with this bid to cover ratio, the first thing that we're going to do is take the total amount of money that was tendered or bid, and that in this case is going to be $140 billion. Now, the actual amount that was accepted, and once again, this is just determined in advance by the Treasury Department, was $46 billion. Now, when you go ahead and take the total money bid and divide it by the total money accepted, the bid to cover ratio in this case was 3.048. Now, if I switch over to the March results for that same 1-year T-bill, you can see that there was only $132 billion bid and $46 billion accepted. If you do that same math of total bid divided by total accepted, that's going to give us a bid to cover ratio of 2.878. Now, obviously, you have to sort of look at the trends and average this all out, but in general, the higher the bid to cover ratio, the stronger the auction was, the higher demand that there was, and that is a good sign for Treasury auctions. As an actual investor in the treasuries, however, it's often better with a lower bid to cover ratio because this means that there are less people bidding and the chances of the high rate being higher than usual is also going to be a higher chance. Now, if that doesn't really make sense, once again, it might be helpful to go and review the video that I did on how the auctions work, but basically the less people that you have bidding, the less likely that those $46 billion are going to get filled up at a lower interest rate, therefore paying everyone a lower rate. Now, the next thing that we're going to go ahead and have a look at with those two examples is the price tail. And what this is the gap or the difference between the average price or average interest rate and the lowest price, which in this case would actually be the highest interest rate. Now, this too can show us a little bit of an illustration of demand, and it's perfectly illustrated with these two auction results. So let me go ahead and show you how that works. So once again, the price tail is the difference between the median or middle interest rate and the high rate, which in this case would be 0.03%. When we compare this to the March results with the median rate of 4.76%, and the high rate of 4.81%, that would have a price tail of 0.05%. Oftentimes, when the price tail is higher, the difference between the high rate and the median rate is higher. That indicates a little bit of a lack of demand for the bills, because this means that the Treasury couldn't fill up that $46 billion that they were looking to accept until they went up higher on their interest rate to fill more orders. Now, if you remember the trend with the bid to cover ratio, we discovered that the March results had a lower bid to cover ratio of under 3. And in this case, they also have a higher price tail. So those two trends align perfectly, showing that the demand for these March treasuries was a little bit lower than the demand for the January treasuries. The last thing that I want to cover on today's video is this very bottom box, discussing what is the difference between a primary dealer, direct bidder, and indirect bidder, just so you can fully understand everything on these treasury reports. First, we'll talk about the primary dealers, and you might have seen that they actually tender the highest amount of bids on auctions in general. These are banks or financial institutions that have been approved to trade securities. They're the big dogs that sort of have that link with the national government to make large bids on these securities. You can see here that it says that they sort of act as a market maker for the US Fed. And what this means in the simplest terms is they sort of set the market for these treasuries, largely because they purchase so many of them and they deal them directly to the consumer. Now, our second group on that list, you might have seen, actually had the smallest volume of bids, and that is what is called a direct bidder. The idea behind this is that they are also just buying the treasuries directly for themselves, but they don't have that qualification of being considered a primary dealer, so they just call them a direct bidder. And our last group is indirect bidders, and now you might begin to understand why I was emphasizing the fact that direct bidders are able to purchase these for themselves, because indirect bidders have to purchase their securities via another party. Now, the majority of these purchases that come from indirect bidders are actually going to be coming from banks from other countries, and they have to purchase their orders through those primary dealers that we talked about earlier. Now, you can see that these indirect bidders can actually play a huge role in the treasury market at times. Back in 2021, there was an auction where over 70% of the bidders were indirect bidders from foreign countries, so they do actually play a large role in setting the rates for the US debt. I hope you went on to enjoy today's video and learn something new. If you have any questions or comments, make sure to throw them down in the comment section down below. While you're down there, leave a like and subscribe so you don't miss any more videos. But other than that, we'll see you in the next one.